Hi, this is Paul Drockton with Drockton Bullion and my website moneyteachers.org. Today we're going to talk about value. We're going to talk about stocks. We're going to talk about PE ratios. And when you look at the stock market, what you're really investing in is a business. You're buying a business when you buy a stock. So when you look at that, the measure of value of that business is known as the price to earnings ratio, or PE ratio. Price to earnings simply means what you are paying for the stock versus its annual earnings. So if you have a PE ratio of 20, then that simply means that that stock is selling for 20 times its annual returns. So that would lead to about a 5% annual return on investment with a PE of 20. Now, historically, when you take a look at the stock market, one thing that is true and will always remain true is the fact that the market corrects the value. So value simply means the market will move towards a lower PE ratio. And we look at the S&P 500, which represents 75% of all the money invested in the stock market. 75%, 75 cents on the dollar invested in the S&P 500, we can track historic PE ratio. And when you take a look at, we'll go back to 1900, PE ratios were averaging about 22, 23 times earnings. Now, when we follow the ratios through the correction that began in 1900, we see that by 1920 the PE ratios had corrected down to 5. So PE ratios went from 22, 23 down to 5 in 1920. Then we saw massive investment come into the market, and PE ratios went from 5 all the way up to 30 on Black Tuesday. When the market corrected, and that correction lasted until about 1932, PE ratios were back down at 5. Now, what does that mean? Well, it means simply stated that individuals that bought stock when PE ratios were at 30 and when it corrected down to 5 lost almost all of their money. Now, we follow that trend and we see that throughout the 30s, stocks went back up. PE ratios went to 22. Another correction took them back down to about 7, 8. By 1965, they were back up to 25. PE ratio then corrected to its low in 1981, where it was at 7. And then from 1980 to 2000, PE ratios went from 5, 6, 7, all the way up to 44. And we've been in a correction ever since. So today, the average PE ratio of a stock trading on the S&P 500 is 20. Now, historically, a PE ratio of 20 means that it's high, that price to earnings ratios are still extremely high, and that we're looking at least another 75% correction in the value of stocks, which could come as soon as this year. So when we look at that, it simply means that if you have $100,000 invested in the stock market today, in order for stocks to correct the value, which is what they've done historically, you're going to end up losing $75,000 of your investment, which would take it down to a PE ratio of 5, 6, or 7. That's where they should be. Now, when we look at stocks like Facebook, which when it came out was trading at $38 on the initial public offering, we see that Facebook had a PE ratio of 70, which made it a grossly inflated stock, and simply meant that it had nowhere to go but down. At 70, that's 5 times what the average is for the S&P 500. So for Facebook to correct to 5, its stock would have to be trading at $2.28 a share. And between $2.28 a share and $5 a share, you could claim legitimately that Facebook would be a value stock, something that you could make money on. So those individuals that bought Facebook at $38 a share when the PE ratios were 70 on the stock obviously made a huge mistake. Now, this is forgivable for the average investor, but not for the institutional ones. And the question remains, why would an institutional investor take a risk on a stock with a PE ratio of 70? These people get paid to manage your money. It doesn't make sense, does it? Well, the reality is that we know that the stock market can also be used as a means to transfer wealth. And we know that the way it works is they pump up the value of the stock. Facebook ended up with $100 billion being dumped into it by institutional investors. When you read or when you hear about these investors buying this or buying that, we're talking about institutions. We're talking about mutual funds. We're talking about insurance companies. We're talking about banks. These people have professional money managers. There's no way that they're going to make a mistake on value unless it's intentional. And that's my point. And if it's intentional, that means that they knew that Facebook wasn't of value, but they put all this money into it with the hopes of, not with the hopes, but with the reality that they would make money when the stock corrected the value. And the way they do that is they take out put options against the stock. So the losers are you and me. Not me, I don't invest in the stock market. Are you, if you invest in the stock market. The winners are them. Because as Facebook corrected from a 70 PE ratio down to where it's today, and as it continues to correct, these individuals will be holding put options against the stock, and they'll make money as the stock loses value. My friends, it really isn't hard. We have to get back to looking for true value. We got to get back to looking at reality. And for the most part, buying stock in the stock market has been a bad investment historically, because the market historically has been in corrective mode 4 times more than it's been in growth mode. So there's really almost impossible to make money in the stock market unless you catch it when it's in a growth mode. When stocks are back down with a PE of 5, then it's going to be in growth mode. Not until then. In the meantime, you can continue to expect the stock market to correct towards value. You can continue to expect the market to lose money. You can expect your mutual fund to decline, and any of your other investments. And it's just a massive way for them to transfer wealth. Thank you for listening. This is Paul Drockton. My website, moneyteachers.org, and I am the owner of Drockton Bullion. And gold and silver have continued to appreciate over the last decade, and they'll continue to do so. Have a good day.